everyone, to another episode of Wolf Street. For those of you that don't know, my name is Wolf. And for those of you that do, thanks for checking me out again. Like always, you can check me out on all social media platforms at Every Time I Cash. That's no dots, underscores, money signs, whatever. It's just Every Time I Cash. And a note, I will never reach out to you in a DM asking you for money. So if you are getting a DM from someone pretending to be me, it's not me. Don't send them any money. Send money to people who actually need it, if you can afford it, that is. And don't send anybody money who is pretending to be me. They're a scammer. Like always, these videos are intended for informational and educational and entertainment, emphasis on entertainment, even though it's kind of boring sometimes, purposes only. They're not to be intended or substituted as financial advice. If you're looking for financial advice, please seek the help of a financial professional. Talk to someone, build a plan that's best suited for your needs. Don't get a margin call from Julia on a Thursday. Important distinction here, a Thursday, not a Friday, at 4 p.m. telling you that you need to pay off a margin debt. So please don't YOLO your life savings on the back of something some idiot, Anon, that's me, says. Just talk to somebody, build something together. Don't end up getting divorced on the back of making a bad decision like that. Anyways, so it's a busy week. A lot of stuff's happened in the last couple of weeks. I like to make these videos at inflection points of some kind, and when things kind of materially changed. And I think that now is time, as good a time as ever, to kind of put together a quick video and kind of gather my thoughts. So without further ado, I'm just gonna roll this for you. We all know what's going on as of late. Russia entered the Ukraine, and they're going back and forth, and they're fighting now. Market's been on tilt a little bit as of late, and a lot of this tumult that's kind of taken place has set us up for a rocky and a tumultuous time as of late. So this all leads up to several Fed speakers speaking this week, Jerome Powell speaking tomorrow, and a lot of people kind of confused, oil breaking 100. A lot of people kind of confused and looking for some sort of understanding of where to go. Now, I might not have all the answers, but I can kind of give a little bit of some of the clues that I'm looking for. So first things first, the way that this has kind of played out has been an allegory to 2005 and 2011. It's been kind of like lockstep. In 2011, in fact, you had a European situation that kind of rocked things a little bit early on, and it essentially goes from people being in an economy where they're buying shit, and now they're gonna ultimately, we open up on the back of COVID no longer being a thing, I guess, and because of that, people are going to start doing stuff now. Primarily, when you have these transitions, you end up having a lot of the underweight assets or assets that make up a smaller percentage of the market having to see a rebalance, and vice versa. So you'll see these like Apples, Googles, Amazons, Teslas, etc. that have kind of carried us the bulk of the way. You see people needing to get out of some of those names and then reallocating into some of the other names that set us up for the back half of this year and ultimately into next year. So with that being said, and with everything that's kind of happened, the Fed's kind of been boxed in, right? So essentially, inflation is high enough to where they have to do something based on what they say, and it's also unemployment is low enough to where they have to do something, right? So this is all a part of a plan that they lay out for us. Now, with the economic transition underway, it kind of creates a little bit of uncertainty. We just kind of went over that. And then the Russia-Ukraine chaos kind of sets people up for a little bit of uncertainty as well. Now, the one thing is, on the back of Russia, Ukraine, and on the back of this uncertainty or whatever, a lot of people are starting to price in this perception that maybe the Fed doesn't act, maybe they kick the can. Now, if you just look at some of the data behind this, generally markets kind of go, they overshoot to the upside, overshoot to the downside. And that's also the case with expectations. So the last time that I talked about this topic, I think it was a space a week ago and a space 2 weeks ago, the market itself was pricing, prior to the Ukraine-Russia thing, the market itself was pricing a 50 basis point hike at about 90%. And in a span of 5 trading sessions where nothing happened outside of Russia, Ukraine, and the market selling off, of course, on the back of that. That 90% number shrank to about 10%. We're sitting currently at basically zero, right? So in a span of 5 days, we went to a sure thing that the market was going to, or that the Fed was going to move on a 50 basis point move, and now we're sitting at a 0% chance that happens. Now that creates a little bit of optimism for some people. A lot of people think that the Fed won't act because of what's going on in between Russia and Ukraine. But essentially, if you just take a look at some of the data, when that data was out, pricing a 90% 90% chance that we get a 50 basis point move. It was also, a lot of people were also pricing in 7, 8, 9, 10 hikes. Now that's not going to happen. I don't think that's reasonable either, right? But if you just take a look at some of the data, and one of the strongest measures for this is the euro dollars futures forward curve. It doesn't actually show that the Fed's going to change what it is that they're doing, right? So it doesn't show us that the Fed's going to come off of the path that they've set for us. So essentially, what that means is there's a probability that we overshoot to the upside on our expectations of what the Fed is going to do, and then we walk back on the back of those expectations, right? So the Fed is telling us that they are going to hike. They're going to need to hike. They're going to need to combat inflation. Oil just broke 100. WTI oil just broke 100. Brent broke 100 last week. Like, there's no signs of this inflation and some of the things that they use for inflation to slow down. So they're kind of boxed in where they have to act, but they don't necessarily have to act in a sense where they go above and beyond, right? There's enough stuff going on that kind of keep people at bay, and it gives the Fed a little bit of ammo and a little bit of opportunity to kind of act, but act slowly, act measured, and just keep everything at bay. So with that, like, let's just move on to some of the stuff that we're seeing, some of the levels, right? So essentially, we've been in kind of what is a down-sloping channel in the S&P, and we came down and hit this 4,100 level, hammered off of it, rallied back. Now, one of the things that happened is we broke this uptrend, and we're kind of battling back against it now. That started in late 2020, right? So late 2020, we broke out after making an all-time high in early September of 2020. We sold off, basically W pattern, and we broke out late 2020, and we've been in this uptrend ever since, right? So we violated that trend last week on the 23rd, and then we really gapped down on the back of the Russia invasion, and we've rallied ever since. So when this stuff happens, you basically create damage, and a lot of this damage needs to be unwound in order for something more material or more structural to happen. So currently, we're in this place of like digestion. We're in this place of tumult. We're in this place of some people want to be long because they've seen the market sell off as much as it's sold off. We sold off about 20%, basically to the penny. And then some people are seeing opportunities as a lot of the cohorts within the market have sold off significantly more than that 20%. So just think of names like Twilio, Roku, Zoom, Square, et cetera, right? Now the QQQ, which is the NASDAQ essentially, shows you a more violent move as we came off of 410, basically sold off to 310. It shows you a more violent move, and essentially you had this like downward sloping head and shoulders pattern that we violated for a day. We've rallied since, and now we're testing back up against that 20-day moving average. So what does this mean? Essentially, if we can get through this 20-day, there is a possibility that we get up all the way to the 200-day, 50-day, and we could see some momentum to that point. But basically, until we have some sort of structural shift from an economic standpoint, from a Fed standpoint, from a Russia-Ukraine standpoint, from a lot of this uncertainty, we're going to be in these situations where we get these violent moves to the upside and violent moves to the downside, and we chop around in between them. So with that in mind, how I trade things and how we trade things essentially is we wait for some of our some of the things that we look for as extremes to flag, and then we kind of take our shots. So first things first, I've shared this before. It's a little, let me zoom in. It's a little cropped, so forgive me. I've shared this before, but essentially this is the S&P 500. It's a 1-year daily chart. This is courtesy of Bloomberg and Canaccord Genuity. One of the tells that I like to use is, it's a tell that they like to use as well. It's the percent of stocks that are above the 10-day moving average and 50-day moving average. So historically, when you get to a point where you see the 10-day moving average, the percent of stocks above the 10-day moving average drop below 10%, and the percent of stocks above their 50-day moving average drop below 35%, or 30% in this case, you find yourself in a situation where you get a little washout. Now, last week, when we had that whoosh down, we definitely got there, right? So we definitely saw a situation where we got that extreme move to the downside, and we had that washout. In situations like that, I like to look long, and then the opposite is true, right? So generally, when you get up to the opposite point, you get, in some cases, 80% of stocks above their 80% of stocks above their 10-day moving average, and then over 60% of stocks above their 50-day moving average. That's generally an extreme as well, right? So I like to look for these extremes as basically barbells for when I want to ease off the gas and when I want to get aggressive, right? And you don't have to necessarily use it to get aggressive. You could just use it in conjunction with laying out levels. So in this case, you lay out your levels and the market breaks down on a gap down, and then you get this violent reversal back to the upside. And if you just use these levels in conjunction with the percent of 10-day and moving percent of stocks above their 10 and 50-day moving averages, you set yourself up for a little bit more success, right? So with that in mind, you can go back and you can just take a look at like where we've gone and where we've come back to. So in the IWM, here's another example. We've broken down. Now we've ricocheted back. There's a chance that we can get back up to that 50-day, and then ultimately, if we can get to that 150-day, it'll set us up to a situation where probably going to see a little bit of selling and people taking profits. But essentially, as long as these moving averages are above, they create an overhead supply. It's just a representation for overhead supply. I'm not saying that technically speaking they have to honor these things to the penny. No, just simply you're looking at overhead supply, and generally on the back of some of these moves that we've seen, when you get back to these overhead supply levels, market participants tend to take a little bit of profit, right? So moving along, the one thing that's important about the Fed, and one thing that I want to just really kind of drive home here, is there are two camps. There's a camp that tells you that we got to go back and retest the lows, right? That you heard those people all through COVID, and we never went back and retested the lows. And then there's a camp that says that we don't have to, right? So if you're using the COVID sell-off as your blueprint for whether or not you have to retest the lows, it's important to know that back when that happened during COVID, in April of 2020, the Fed started buying high-yield debt. They're not going to buy high-yield debt. We can just debate about it, but they're not going to buy high-yield debt to support the market like they were. So it's a completely fundamentally different approach to the market. So I think as long as they are not buying high-yield debt and they're telling you that they're going to have to raise rates and they're going to have to roll off some assets to combat inflation, that you're going to be in a situation where you get these fits and starts. You get these oversold extremes, rally snapbacks, and then you sell off again, and vice versa, right? So as long as that's the case, and as long as inflation is here to stay, these are some of the instances that you're going to see. So we just finished February, and year to date, we're down 8.23% on the S&P 500. February closed the month down 3.17%. This is the first time the S&P had back-to-back down months since September, October of 2020. So this is not setting up to be an ideal situation for the market. The Fed still has to taper their asset purchases. They have to raise rates. They have to do whatever they got to do to combat inflation. You got inflation running rampant. You got World War III on the cusp, right? So you got all this stuff. And not to mention, you start off the year 2 consecutive months in the red. Now, I mentioned that World War III tongue in cheek, but it's important to talk about, right? So as long as we don't get to a nuclear catastrophe, right? At some point, the market will start to price whatever's going on in Russia and Ukraine. So I say this with empathy and with understanding that it's a war-torn situation. A lot of people are going to die needlessly. A lot of people are going to suffer, and it's going to be a tragic experience. I say this not without a consideration of those facts, but as long as there's no potential furthering expansion westward, and as long as there's no nukes involved, you could get these like on the edge situations for a little while. But ultimately, over time, the market will start to price that in. It doesn't mean that we, money printer go burr and we rally back to all-time highs. It just means that at some point, the market will discount whatever it is going on over there, and they'll start to price in some of the sanctions and some of the stuff that's going on in Russia. So it's important to pay attention to that and just kind of know that and keep that in the back of our minds. But in general, Fed is in full focus. JPOW tomorrow. Let's see if he doesn't walk back the way that they're going. Let's see if they keep going down the path that they said they're going to go down. And let's see if some of the stuff that we have seen is temporary or if it's going to persist. Now, with that all being said, I want to say thanks for your time. Thanks for checking me out. Thanks for watching. Please like, comment, subscribe. And if you have any questions, reach out to me directly at everytimeicash or everytimeicash.com/contact. I'm not sure what happened here. It's supposed to just say Doji, but I'm not sure what happened. But anyways, reach out to me directly everytimeicash at everytimeicash on social media or everytimeicash.com/contact. Thanks for watching. Thanks for your patience. Please stay safe, stay profitable, and as always, stay locked in.